Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications.
Hey everyone, Joy here. Today, I've got some seriously exciting stuff to share with you. We're talking about the epic AI chip battle between Google and Nvidia that's getting super intense, some hidden problems in the US job market that might force the Fed to cut rates big time, uncertainty around Trump's tariff case that could be decided in 2026, energy challenges for power-hungry AI data centers, and some S&P 500 index changes that made several stocks jump beautifully. Let's dive right in. Joy Up Invest Podcast. Invest better every day. Hello, dear listeners, and welcome to Wall Street Wake Up, the show that wraps up and updates you on what's been happening in the U.S. stock market and markets around the world over the past 24 hours. Let's start with what I think is going to be the hottest story right now, the AI chip war between Google and Nvidia. The global market is facing massive changes in AI technology that's becoming the main battlefield of the future. Google just launched their Ironwood chip, also known as the 7th generation TPU, which is a direct challenge to Nvidia's dominance. It's like if there was only one noodle shop in the neighborhood, and then a new guy opens up right across the street, claiming his noodles are twice as good. Google has been developing chips for over a decade now. This isn't just playing around. What's interesting is that Google's Ironwood offers twice the performance compared to the previous generation, showing their serious commitment to reducing dependence on outside suppliers and creating their own competitive advantage. What's really worth watching is D.A. Davidson's suggestion that Google should consider selling these chips to external customers instead of just keeping them for internal use. It's like making a delicious cake for yourself. Why not sell some and make extra money? Especially when companies like Anthropic and xAI are looking for alternatives to Nvidia. Talk about perfect timing. But wait, there's more to this story than meets the eye. The latest data from Omdia Research shows the game is changing way more than we thought. Google's TPU purchases this year are expected to be between $6 and $9 billion. That's such a huge number, it could actually reduce Nvidia's market share for the first time ever. And here's the kicker. OpenAI, which is Nvidia's biggest customer, just started using Google's TPUs for the first time in a meaningful way. This is a signal that even the companies most tied to Nvidia are starting to look for alternatives. That's bad news for Nvidia, but massive good news for Google. What's really important is that Google is negotiating to install TPUs in other cloud providers' data centers for the first time. This means Google is openly challenging Nvidia by going after their customers directly. This isn't just technical competition anymore. This is head-to-head business warfare. The data that gets me excited is that developer activity for TPUs on Google Cloud increased 96% in just 6 months. That's incredibly strong growth. And Google's AI business valuation jumped from $717 billion to $900 billion. But the main challenge is still separating this business into an independent unit, which D.A. Davidson admits is difficult. It's like trying to separate egg yolk from egg white without breaking it. Definitely not easy. From an investor's perspective, I think we need to look deeper than just performance numbers. Google investing over $1 billion in TPU development between 2020 and 2024 shows clear long-term commitment. But what investors need to watch out for is that Nvidia isn't sitting still. They've accelerated their product development cycle from 2 years to 1 year, with plans to launch Blackwell this year and Rubin next year. This is a marathon battle we'll need to keep watching. Investors might need to wait for clearer financial disclosure from Google first. In the long run, if Google can successfully build a strong AI chip ecosystem and expand their customer base, they could become a real competitor to Nvidia, especially for companies that want flexibility in customizing their AI systems.
All right, from hot tech news, let's look at something worrying happening in America. The U.S. job market is showing some concerning signals. Jeffries pointed out 3 deep problems hidden beneath job numbers that look okay on the surface. Non-farm payrolls only added 22,000 jobs in August, which is really low. And when you dig deeper, you'll find that unemployment for young people aged 20 to 24 jumped to 9.1%, or 12.7% if you include those who dropped out of the workforce. Yikes! That shows young people are having a really hard time finding jobs. The no hiring, no firing situation means people with jobs stay safe, but those looking for work face serious difficulties because there are very few new positions opening up. It's like musical chairs, but the music never stops. People sitting stay sitting, and people standing have to keep standing with no chance to find a seat. The most worrying issue is the increase in permanent job losers, which rose from 0.7% to 1.1% of the workforce, along with the U6 unemployment measure that includes discouraged workers and underemployment rising to 8.1%, the highest level in this cycle.
Next up is something that feels like a long drama series: Trump's tariff case that U.S. courts are preparing to decisively rule on. The decision is expected between March and June 2026. This is super important because the disputed tariffs account for about half of all U.S. tariff revenue and could expand to 70% in 2026. We're talking about a really big chunk of money. These tariffs include 25% on imports from Canada and Mexico, 20% fentanyl-related tariffs on China, and 10% retaliatory tariffs on China. The appeals court's 7-4 decision that these tariffs are illegal but remain in effect during appeals creates short-term uncertainty but medium-term clarity. It's like knowing you have to take a test, but not knowing what questions will be on it. You have to prepare for all scenarios. I just got data that the Justice Department will ask the Supreme Court to review this case, but Barclays expects markets to react calmly because tariffs remain in effect during the legal process. For investors, the key is preparing for both scenarios. If the Supreme Court decides to cancel the tariffs, there might be widespread tariff refunds to importers, which would benefit companies affected by these tariffs. But if the court upholds them, the government might use other trade powers to impose new tariffs. From an investor perspective, this medium-term uncertainty might create opportunities for risk takers, especially in stocks of companies that benefit from international trade. If tariffs get canceled, these companies would benefit hugely, but if upheld, they maintain status quo. The downside risk is therefore limited.
Now let's get to something I find super interesting: the renewable energy issue with power-hungry AI data centers. BCA research came out challenging widespread beliefs by stating that renewable energy's role in powering AI is overhyped, which contradicts IEA predictions that renewables will meet nearly half of new data center electricity demand by 2030. The reality BCA points out is that AI data centers prioritize power stability over cost and environmental considerations, because even a brief system interruption can cause massive damage. Simply put, it's like a patient's life support machine. If power goes out even for a second, it's extremely dangerous. The main problem preventing renewables from adequately meeting demand is infrastructure limitations, especially power transmission capacity, since renewable power plants are often located far from demand centers. It's like having delicious organic brown rice, but it's really far from home, and when you're hungry and need to eat right now, you have to buy white rice from the nearby store instead.
There's additional interesting data supporting this. BCA research's claim that renewables are overhyped is backed by the reality that in the US, there's nearly 2,600 gigawatts of renewable capacity waiting for grid connection, with 95% being renewables, but the connection process is long and complex. Europe faces similar problems, while China, despite having high solar and wind potential, still has to curtail production due to grid limitations. Energy storage is another major hurdle because projected capacity additions by 2030 will cover only about 2/3 of what's needed to support data centers running on intermittent power sources. It's like collecting rainwater for year-round use, but not having enough storage tanks. Policy changes aren't helping either, especially the reduced tax credit eligibility periods for solar and wind in the US, affecting $263 billion worth of projects, while China's pricing reforms, shifting from coal-linked benchmarks to market mechanisms, have reduced revenues. In this context, natural gas becomes the main attractive option for investors. BCA predicts natural gas will be the primary energy source replacing renewables throughout this decade, which is good news for companies in the natural gas and LNG industries. Europe, increasing its LNG dependence, will expand import capacity by 50% from pre-Ukraine war levels by 2027. 5 countries, hosting nearly half of Europe's data centers, account for 85% of LNG capacity under construction. From an investor perspective thinking about assets, the question isn't whether renewables will win or lose, but the timing of the transition. Investing in natural gas medium term while investing in renewables long term might be the most balanced strategy. I think for investors, investing in natural gas production and transportation companies could be a good bet medium to long term, as increased demand from AI data centers and global LNG expansion should narrow the Henry Hub discount compared to international benchmarks.
Finally, we get to good news for several stocks that got upgraded to the S&P 500 index. Robinhood, AppLovin, and MCore Group joining the S&P 500 on September 22nd is great news for shareholders of these companies, because joining major indices usually brings investment inflows from index funds and various ETFs. It's like getting promoted from high school to college. More new friends, better budget. Robinhood jumping 7.1% and AppLovin rising 7.4% in after-hours trading reflects investor expectations of investment inflows. However, what's notable is that MicroStrategy, which many expected to be selected for the index, didn't appear on the final list, causing the stock to drop 3.1%, showing investor disappointment. It's like preparing for entrance exams to a prestigious university, but your name isn't on the eligible candidates list. Super frustrating. This change also extends to S&P Mid-Cap 400 and Small-Cap 600, creating opportunities for investors interested in mid-cap and small-cap stocks to consider companies that got upgraded. Besides Robinhood, AppLovin, and MCore Group joining the index, there are also changes in Mid-Cap 400 and Small-Cap 600, creating opportunities for investors looking for cheaper stocks. Index inclusion typically creates investment inflows from index funds and various ETFs, supporting prices. But what professional investors often do is buy before announcements and sell after index inclusion, because most effects happen in the short period after announcements.
What's really important is the contrarian investment perspective. While everyone's excited about AI and technology, some professional investors are looking for opportunities in overlooked assets, like traditional energy stocks, construction material stocks, or even emerging markets not yet affected by AI hype. Risk diversification isn't just investing in multiple stocks, but investing across multiple themes, geographies, and time periods, because what's hot today might be cold tomorrow. Another interesting perspective is about timing. Many professional investors think we're in the late cycle of the bull market, meaning investment returns might not be as high as 2-3 years ago, and risks are starting to increase. While Fed rate cuts are good news short-term, they also signal economic slowdown. Preparing for potential market corrections is important, whether that's holding more cash, investing in lower-risk assets, or using risk hedging tools.
Looking at the big picture, we can see global markets facing major changes in multiple dimensions. Intensifying AI technology competition, job market uncertainty that might lead to monetary policy changes, challenges in securing clean energy for data centers, and capital market adjustments. For investors wanting to succeed in this rapidly changing environment, good risk diversification, close data monitoring, and readiness to adjust strategies according to changing situations are essential. investing in high-potential tech stocks like Google, energy companies benefiting from increased demand, and companies joining new indices might be good long-term opportunities. But we need to watch out for short-term volatility from macroeconomic factors and policy changes.
To wrap up, today we've seen the big picture of a changing global market, from the AI chip war between Google and Nvidia, where Google is gaining advantage with billions in TPU orders and OpenAI starting to use TPUs, to US job market problems that improved in September but still have structural issues to watch, uncertainty from Trump's tariff case that might create opportunities for risk-taking investors, renewable energy challenges making natural gas a medium-term star, and S&P index changes creating short-term opportunities but requiring good timing. The most important thing is having diverse perspectives, risk diversification, and preparing for both opportunities and risks that might arise. Because in the investment world, the only certainty is uncertainty. But if we prepare well and have complete information, we can turn that uncertainty into opportunity. All of this is just my personal view. It's not investment advice. Please use your own judgment and do thorough research before making a decision, because all investments have risks. Before we say goodbye today, if you're a stock trader and you have questions but don't know who to ask, feel free to leave a comment and we can chat. See you next time. Bye-bye.